Director of Entrepreneurial Services at Valcassen. And today we're going to talk about a topic that is both old and new. And the reason why is because the ERC, or Employee Retention Credit, was originally voted on and passed as part of the CARES Act way back in 2020. And everybody kind of forgot about it because one of the conditions is that you couldn't take the ERC if you had also participated in the PPP, which is the Payroll Protection Program, which we've talked about in other videos. But now, as of the passing of the Appropriations Act that we have of 2021, ERC has been revived, and the reason why now is because there is no longer that condition that you can't take both the ERC and the PPP. So now it's really relevant to talk about it. So I want to go over with you today the eligibility, the calculation, and then how do you actually get this credit? Because for some employers, this credit is big, and I'll tell you about that in a minute. But right now, here's your eligibility requirements. You had your business fully or partially suspended in at least one quarter in 2020 due to government orders. Or you had a 50% drop in gross receipts for calendar quarters in 2020 compared to the same quarters in 2019. And you can take this through the end of a quarter that you then received 80% of gross revenue. Now, I love examples because I just threw out a bunch of percentages and numbers. So let me give you some examples. In quarter 2, you're at 45% gross revenue of what you were before. Quarter 3, you're at 85%. You will qualify in both those quarters because you met the qualification in the Q2 quarter. So what is so nice about this 50% requirement is that once you meet it in one quarter, you automatically meet it in the second quarter. So when you're looking and evaluating the EIC, you first want to apply the 50% calculation because that's going to help you capitalize on this credit much more than just a full or partial suspension of business. Now, let's talk about the type of government orders. First, I mentioned full suspension of operations. So the order has to limit your commerce, your travel, group meetings in any way that would affect your business operations. Again, I'm going to give you an example. The governor issues an order that all non-essential businesses must close from March 14th to May 1st, which was actually pretty common here in Delaware. Therefore, non-essential businesses would qualify for the ERC. But let's compare that to partially suspended. Restricted operations is mentioned above for employers that can continue some, but not all of its typical operations. So for example, a reduction of operating hours under a government order would qualify for the ERC. There's another example I love too, which is a restaurant. So we have a restaurant that did shut down, but then it did open, so it was partially, but its indoor dining was suspended, but it was creative, and so it started having a great takeout business and maybe some outdoor dining. That is still considered to be partially suspended. Let's take that same restaurant and say that they can have indoor dining, but it's limited to 30%. That also still qualifies them for partially suspended. Certain telework conditions will still qualify you for being partially suspended. These rules are so detailed, so I'm just going to give you the highlights, and if that does apply to you, you'll want to do a little bit more research. So let's talk about the significant decline in gross receipts. We're going to begin with that first calendar quarter in 2020, which is January through March 31st. And we're going to look at the gross receipts for the same calendar quarter in 2019 and evaluate if they're less than that 50%. Now, I have to tell you, this act restores the credit for even 2021 with even different calculations, and we'll talk about that at the end. Tax-exempt employers also qualify, but here's what's considered to be your income. Investment income, that would be dividend income, interest income, contributions, gifts, and grants, and any kind of assessments or dues that you may collect. So let's spend a little bit of time talking about qualified wages. What are those? Well, it depends on the average number of full-time employees during 2019. We're going to call these FDE, full-time equivalents. And you're considered to be an FDE if you have average hours of 30 hours per week or 130 hours per month. It's important to note that because for the PPP purposes, the the FTE hours were much higher, so this is a reduction, which is good. Or if the employer experienced a 50% or greater drop in gross receipts. And those are all those examples I went over before. And the nice thing is too, is that you can include qualified health insurance that's paid for your employees if the employer pays it. Now you do have to net that for any kind of premiums that the employee pays. Now let's get to the really nice part of this. You can count up to $10,000 of wages, and so this can be cumulative in any quarter that you qualify, $10,000, and the credit is 50%. So you heard that right, 50% of $10,000 is a $5,000 credit. A credit is a dollar for dollar reduction of taxes, whereas a deduction just reduces your income for calculating tax purposes. So a credit, so much better than a deduction. Now you do have to keep in mind though that the payroll wages that you normally take a deduction for, you will have to reduce them by the credit, but you are still going to come out way ahead by taking the credit versus the deduction. Now let's talk a little bit about 2021 and what this means, because this has now been extended into 2021. It's very similar, and you are going to have to catch this on your 941. So for 2020, you're going to amend those past 941s of those quarters you qualified. For 2021, you're going to capture it on your Q1 941 that you haven't even filed yet. Now, if you know you're going to qualify and you don't want to wait for your quarter 1 941, you can file Form 7200, and that's an advanced claim on that. So you can file that form to get it. 2021 rules are slightly different than 2020. You have to only experience a 20% drop in gross revenue and a 70% aggregate of wages of 10 grand. So what that basically means, instead of that 50%, we're at 20, and instead of a $5,000 credit, we're possibly at a $7,000 credit. And in 2020, you can only use that 10 once, but in 2021, every quarter that you were still restricted by your operations, you can keep using that same $10,000 figure. So for 2021, this credit is even better. The only thing is some businesses have been fully restored, so 2021 probably might be the only year that they're going to get it. Whereas if you're still partially suspended, you're going to be seeing this credit possibly in both years. So I threw a lot out to you, a lot of calculations. It is complicated, so I really do encourage you to reach out to your accounting team for help in this so you can maximize the credit that your business deserves.